Tokenize, let's innovate, bringing assets to the digital state. From finance to games, we're redefining, connecting the dots. The future is shining.
We've got a good panel here on arguably one of the hottest topics of today. Digital asset treasuries, good, the bad, and the ugly. So digital asset treasuries did not start with Michael Saylor. They actually technically started with Barry Silbert when he created a stock called GBTC that took his Bitcoin trust that he created at the end of 2013, was for accredited investors. They would go in and I think they raised about $100 million to put it into a trust. And then if you held it for, I think it was a year, you could then put it into this stock. And the stock was trading for quite a while at about a 30% premium. So it's a pretty sweet deal for family offices and other, kind of high net worth investors. They would go in, put 100,000, 500,000, whatever into the trust. They'd wait a certain amount of time. They would then exchange it for the stock that was trading at 30% premium. Then when they were allowed to sell the stock, they would sell it and then buy back into the trust and repeat the process and, make 30% above the price of Bitcoin if they're able to do that table turn annually. That lasted until all of a sudden Bitcoin, and again, supply and demand. When the markets were going up and when that was the only game in town to buy it as a stock, GBTC was always trading at a premium. I don't think anybody thought it was going to go to being a deficit, to be a discount. And that happened when GBTC said their end game was to go and be an ETF. And of course, as many of you know, it took forever to get the ETFs approved. The first attempt was with the Winklevoss twins in 2013. And of course, it took until, Gary Gensler finally, with his arm being twisted hard behind his back by Larry Fink and others on Wall Street, finally approved the ETFs 11 years later in January of 2024, and they start trading in March. And so there was an opportunity in like late 22, early 23 to have bought GBTC at a 50% discount to Bitcoin. Your risk was there was all sorts of lawsuits pending. Hey, let's break up the company and unleash the Bitcoin because, it's just going to get eaten up in legal fees and this and that. And if you were brave and thought that the ETFs would ever come through, you killed it because you were actually able to buy when Bitcoin was trading around 16,000. You were getting a 50% discount to NAV at $8,000 Bitcoin. And then as soon as it became an ETF, not only did the price of Bitcoin go up quite a bit since then, but you got double the Bitcoin. And so that was a smooth move. We are now in a situation where the new wave of digital asset treasuries, obviously following the example of Michael Saylor, new to Bitcoin until August of 2020, and now owns 72 billion, I think was the latest number I heard in MicroStrategy. The stock has skyrocketed since its lows of, I think it was $7 or $8. And, when he made this controversial move to buy, I think it was 11,000 Bitcoin, or it was a certain number of Bitcoin, I think at 11, I forget the price now, but it was a low price on a low amount of Bitcoin. And, and obviously people called him an idiot, and now he's, proven himself to not be an idiot. And so that's sort of, and he's been making a lot of, speeches all over and saying, this is how I've beaten every stock on the S&P 500 and kind of neck and neck with NVIDIA. In fact, he had a very, you can watch it online, his keynote that he did at the Bitcoin conference in Nashville, where he said, if you want to compete against NVIDIA, good luck. If you want to compete against me, I just gave you the roadmap. Just make loans, buy Bitcoin. And people started doing that. And so I think we're at about $100 billion, I think, of sort of Bitcoin that has been, kind of assigned to or dedicated to treasury purchases. I think that's including MicroStrategies, strategy now, as they call it. And so we're going to say what, kind of powered this new wave. And Tom Lee just said the bubble's popped and it's all over now, which has become surprising because I thought it would at least not pop until the end of the cycle, which I still believe, and that's my next talk, will be end of this year, just like it always is the fourth quarter after the halving. So let's start with Enzo and kind of work our way down.
All right. Well, thanks, Michael. Thanks for having us here. So DATs are a trade. It's a great idea. I was involved in the early stages of BM&R when it was still on the OTC market, and I was like, you're not going to survive being a Bitcoin miner on the OTC, so you have to do something. Kind of brainstormed a little bit, and then he found Tom Lee, which is amazing. Glad I own that stock. But I think, for us, when I started looking at the DAT trade, I expected it to have a lot of volatility. I do think we'll have some more of that volatility, and Wall Street actually likes volatility because then they can trade against it. So it's not a bad thing. It's not great for buy and hold investors. It's very stressful. But I think that we're in a place right now where, we launched a Telegram DAT, and I immediately from day one out, we were like, it can't just be a DAT. So we're a Telegram ecosystem company. So we're here to support the Telegram ecosystem versus just being a DAT. And I think that is probably where most of these things will pivot, especially the ones that are dealing with alts. Maybe not Bitcoin, of course. I think every company should have Bitcoin on their balance sheet. It's like gold, right? So you'd be kind of crazy not to put Bitcoin on your balance sheet as a pubco. So, but I think that these other ones are going to be more focused on building the access to the ecosystem. And in our case, we chose Telegram because I said it's the most mass adoption play. There's a billion users. Pavel Durov said that he'll never take the company public. The only way to get exposure to it is through us or through this other firm that also did one. And we buy Toncoin. We also kind of announced buying a gaming company that is probably the number one gaming company on Telegram. So we're doing more than just a DAT, and I think that's where it's going to end up.
So I'll go to Ron next. Ron, you had a public company and still have a public company, crypto-focused, years before Michael and have been through the slings and arrows of going through several different versions of the renditions of the SEC. Why don't you talk a little bit about the crypto company's sort of start and where you are now in this new era?
Thank you, Michael. I love Michael Saylor, and he's done so much for our industry. It's great. But he started buying in 2020. The crypto company started its digital asset treasury in 2017. And we had the first audited financials for diversified crypto portfolio. We had, even at that time, maybe 50 different cryptos in it. Certainly Bitcoin heavy, weighted very much toward Bitcoin, but some of the altcoins were doing very well. We had a few other firsts. I believe we were the first company to take crypto for our stock as a direct investment, and some others. 2017, I would suggest the regulators weren't really ready for what we were doing, so we had to fast forward until now. So this year, when the doors open, we're all experts in the field. We all watched what had happened. We were part of the story in those early days of working with the regulators. And when the SEC changed in January, I felt like we're really the ones teed up to do something big here. The Sol Strategies, MetaPlanet, they were the early ones last year. It seems like forever ago, but it's literally early 2024. And they did amazing jobs. And I like what Enzo said, and I think he's spot on. The single asset treasuries, I think, have done very well. Well, there's no question they've done well, but there's bigger and more coming. And I love the idea of Enzo mentioned buying a gaming company within a public company that already owns ton. Like that's a flywheel. We're doing the same thing. We just announced a majority purchase of a company this week, and that is in the media and entertainment business. And it's a content, without going into too much detail, it's a content platform. It has Metallica on it, and Bob Dylan, and some really big names, Johnny Cash, and not all musicians. We also have Essence Magazine. They all have their content on there, and it allows them to do wonderful things with the content. It is blockchain underneath it. However, we're going to accelerate the utilization of the blockchain and crypto that it's capable of for all the reasons you've heard at the other panels earlier today. And we think that that is the power. It's being able to buy and or build companies that are the utility rails underneath DePIN underneath this new thing that is going to be moving so fast because we sprinkle AI dust on everything we do. And I'm saying the bigger we on everything these days. And when you do that, you do need that trust layer underneath. And I think we're looking at being part of what's coming. Even the WEF announced less than a couple months ago that just DePIN alone is going to go from where it is now, which I refer to as zero, which is not entirely accurate. But they say in the next 30 months, it's going to $3.5 trillion. I look at that like that's wealth creation. That's $3.5 trillion for one small sector of blockchain. And if you add the others in, just exponentially multiply that. We love decentralization. The great news is this is going to be in the hands of many. I would expect it's not going to be a FANG type of thing. It's not going to be 5 companies you can mention that dominate the whole thing. It's going to be more decentralized than that. There's enough there for everybody. So that's what we're doing. That's where we're going.
Thanks, Ron. So, Keith, you've been an investment banker since you took Activision public many, many years ago. And you also were pretty early into the DAT space. Tell us what that's been like.
Yeah, for those of you that don't know Bousted, we're an investment bank down in Irvine, California. I founded it almost 20 years ago. Our focus is on small cap issuers. For us, that's companies with a market cap of $1 billion or less. And we're pretty prolific in both public and private offerings. I think over the last 8 years, we've taken 60 companies public. And we've had the good fortune of 5 of our clients being used for the DAT strategies. We're working on a 6th right now. Jonathan Bates was one of our reps. And I told the story earlier that FINRA made, I don't know if that's me, but FINRA made his life a living hell, and he left and started essentially the company that became Bitmine. And we were early investors in his private company. We took asset entities public. They have embarked on their own DAT strategy. Clean Core, which is Zone, they are embarked on a Doge strategy. No Labs, Pete Conley, who's one of our reps, was the CFO, and they are now USBC, 100 million pipe by a guy named Greg Kidd. And more recently, my partner Dan McClory, who founded and executive chairman of a company called Brera. We took public 3 years ago. We did the entire cap structure from the very beginning, and recently became Soulmate with the Solana strategy. So we've been in and around them, since they started happening. And what I kind of differentiate between, talk about the ugly, right? So there's some ugly strategies probably that aren't going to work. There's some that I think will. I went through the .com, or as my partner Dan says, the .comedy era. And, the companies that really survived were the ones that took their inflated public company stock and started acquiring real assets and real revenue producing companies. I think you'll see that. But, Michael touched on it. I was with the group I started my first company in 83 in Ann Arbor, Michigan. And then we acquired Activision, which was basically bankrupt in 89. And I learned everything about the capital markets from that experience, and I left in the late 90s. But what I separate is between the business strategy and the capital strategy, because I think like an entrepreneur, even though I'm an investment banker, but I've seen more capital strategies destroy good companies than business strategies. And if you look at the performance of the stocks of the companies that have embarked on DAT strategies, you can tell the winners from the losers just by their capital strategies. And the ones that have what I call the usual suspects, and we brand them as such, they're primarily New York hedge funds. They don't care about your business. They just care about a trade. And if they're in your company, pretty confident your stock is going to go down. And the worst performing, we track them all. we track, I shouldn't say we track them, we track the real ones that have raised real capital and have a real DAT team as part of them, right? Because there's plenty of companies that have announced DAT strategies, maybe raised some money, but there's no DAT team behind it. The real ones we track, the worst performing ones, have the usual suspects in their pipes. So for those of you that are thinking about a DAT strategy, I'm happy to tell you what I think I know, but by all means, try and avoid those investors that just are concerned about a trade and not your strategy. Because if you get them in your cap table, it is very ugly and it's hard to recover from.
So, Josh, what do you see as because you're here to explain risk to people in many markets, what do you see as the primary risks both for investors and for companies?
Well, I mean, for the investor, getting tangled up with the wrong company is, number one with a bullet. There's kind of two prime areas that I would look to. One of them is the business case, because a lot of people kind of think the business case is, okay, I'm going to take a digital asset, I'm going to put it into a public company through reverse merger or however you get there, and it's suddenly going to be worth more than the digital asset was worth because now I'm getting a multiple because it's a public stock, which is absolutely ridiculous. And unfortunately, that's been a lot of them. Then there's kind of a variety that's maybe a notch above that, where you've got your digital asset that comes in, and this I'll call it the ecosystem management play. And it's great, and it's digging into the future, but it's also dangerous because nobody really knows exactly what's going to happen, what's going to actually work. And then there's a third version, which I think has got a lot of promise, which is where your digital asset treasury is actually worked in and part of your operating model. And if you can do that, and one great example of it is somebody who set up a liquidity pool in order to allow people who otherwise take a long time to get paid to trade the receivables for BTC or for a stable, and therefore cash out very quickly, and that's a competitive advantage. That's got some serious legs to it. But the thing is, in terms of investor danger, you got to know what you're looking at. That's number one. From the DAT company perspective, I'll call it a 1 and a 1A. The one, of course, is regulatory. We've got publications where notwithstanding our government shutdown, FINRA, the SEC have both made comments specifically that they're going to be looking closely at the digital asset treasury companies. And some very basic stuff coming out, like insider trading and other asymmetric information type transactions. They just the normies are looking at it and kind of going, okay, how is this not 2017 ICO mania all over again? Except like now they're public stocks and they're getting into people's 401ks and like, oh my God, it's going to be horrible. So they're looking really, really closely, and then kind of an element to that, which is not going to put anybody in jail, but certainly can cost a lot of money. The traditional system, the traditional lawyers, the traditional investment bankers don't understand the ecosystem of digital assets. And the digital asset folks, generally speaking, don't understand securities regulation in the traditional sense of being a public company and what do you have to do and can you do and not do. So there's a language gap, and it's almost like working in a different language without actually having a translator. And again, that can be crushing from a cost perspective, from a capital structure perspective. That might be the warrant issuances that you didn't otherwise have to do that turn everything on their head. So those would be my points.
So I'd said earlier this year that and obviously I'm a student of the cycles, going back to like 2015 when I developed my 4 seasons of Bitcoin, and obviously the basis for my book, Bitcoin Super Cycle, which I'll be speaking about shortly. I sort of saw the digital asset treasury as sort of almost being like an altcoin market for this cycle, because usually you end up having the newbies of every cycle get FOMO into something. 4 years ago it was Dogecoin, right? And other meme coins. 4 years before that, it wasn't so much Bitcoin, it was the ICO bubble. And 4 years before that, it was Bitcoin, because that was about all that was around there. It seemed like this cycle, because the newbie retailers are not the degens buying Doge. They're the, mid-40s married couples with a 401k that have heard about Bitcoin for years, and their kids bought it and made money, and their friends bought it and made money, maybe made money, lost money, but made money recently. And they're like, wow, I can now buy it on my Charles Schwab account. And because I can buy MicroStrategy, I can buy this DAT I just heard of. And so to me, it seemed like, just like the altcoins always bubble popped about a month or two after Bitcoin topped in almost every cycle. And the Web3 VCs usually had hopium a little bit longer than that. And so I thought that, when the bubble pops here, which I'm still, I've seen, I may be the only person who still believes in the 4-year cycle. If you look at some of the people who've like denounced it recently, like Raul Paul saying we're gonna have a 5-year cycle, Arthur Hayes, we're gonna have at least that. Who knows? It's gonna be based on like, what happens with the next Fed chair, which I've got answers to all that. But you know, it would be very unusual now that Tom Lee has said the DAT bubble has popped. And you can see a lot of examples of it having gone way up to like unsustainable. Some of them are coming out like 7x NAV on the launch, et cetera. And then they're going down to most of the big names now, other than MicroStrategy, are kind of like trading at or slightly under NAV. And yeah, it seems a little early for that bubble popping since we're not quite at the end of the cycle yet. I mean, we've had a major pullback, and every couple of hours on now, I'm getting panic emails from someone saying, "Is it too late? Should I be selling everything?" It's like none of the signals, traditional signals of a top zero, have happened yet. So I think we still have some time to go to the end of the cycle, but yet it does seem like at least interim, the DATs have popped. Is that like just down, down, down from here, or do you see sort of a resurrection when we're at a new all-time high for Bitcoin in a month or so? I'll start with Enzo.
Sure. Yes. So, that was too long. So I think that there's a couple of things. One is not all DATs are the same. I do think that like we are doing a Telegram kind of ecosystem play because like there's only really one other company in the world that's on the public markets, and that's Meta, and that owns like Instagram and all that stuff. So to us, we're in a different. We don't even consider ourselves a pure DAT. On the DAT side, I would say that one of the reasons why people love it is because it's a pain in the ass to buy Bitcoin. And then you hear all these horror stories with FTX and, do I really own my coin when I open up that Coinbase account? At least I know that I have this layer of the people who I'm used to trusting. Whether that's a good thing or not, it's up to you. But the fact is that they trust these guys. They trust these custodians. They trust these banks. Like we all do, right? I mean, we all have stock portfolios. So that was the main reason why. I still think I actually bought Bitcoin. I have Bitcoin normally, and then I bought Bitcoin in my FIDO account because I was like, this is pretty cool. I can own Bitcoin in my kind of Fidelity account and see it, and it's easy to see it. Like I like the fact that it works. So I don't think it's I don't think it's doom and gloom. I think these things are cycles. Just like every other Wall Street market subsector in the world, there's the oil turn. I mean, Wall Street is built on cycles. So what goes up must come down. What goes down must come up. So like if you're not experienced in that, then maybe you shouldn't be doing it. But at the end of the day, I don't see it as like doom and gloom. I see it more of you're gonna have winners or losers. Capital market structure. You know how many term sheets I got in the last week that were completely toxic crap, and I'm like, guys, I've been in microcap. I'm not touching it. You're gonna destroy my company and then hold me hostage. The problem is that the microcap market, and the problem is that the IPO market's broken because the regulator's broken. Okay, so that's no one's fault. Stop letting those guys in. You'll get real investors. Like stop letting this happen. So to me, you have to be super smart. And we do have an experienced team. I mean, I've had 5,000 public companies as customers, and I worked at NASDAQ as a head of strategy. I mean, I know what I'm doing, and Brittany knows what she's doing, but I could see DAS having a lot of problems if they don't have a team of people who are like watching out. And the bankers don't really care because they're gone. So it would be great to have people who can say, oh, those toxic deals, don't do those. They may sound good, but they're not. I think we're in two different kind of comms right now where we're talking about DATs and Wall Street's problems, and then whether it's, the token thing just shines a light on it. But FYI, 95% of tokens go to zero, 95% of stocks, they pretty much go to zero. So what's the difference?
Let's see if this works. It does. So the commentary up here from my point of view has been fantastic, and I'm going to distill it down because I live this stuff every day, and it's so good to hear other people saying these things out loud. You start with the toxic debt and the toxic bankers that can live. This is not a blanket statement across all of them, but those do exist out there, and when they do, make no mistake, it creates a big problem for the company that those companies have to work very hard to get out from under and sometimes never do. Then you've got, I'm kind of working my way down. That was started from Keith's comment, but Josh's comment, regulators. Just because they're quiet for the moment doesn't mean you can break the rules. You got to stay between the lines. It's absolutely critical. And I think we're living proof of that because we had to deal with that in 2017, but ultimately no finding of wrongdoing because we stayed between the lines. That's absolutely critical. Then we can talk about the super cycle, and then the multiple businesses. I'm not sure what's going to happen coming up because these single asset DATs that do exist in the public markets, over time, when a super cycle does hit its top and comes down, when Bitcoin or the underlying tokens in these DATs drop by significant amounts, when that happens, what happens? Maybe they could survive it, but there's two things, and I'm getting the high sign by Joyce, but I'll try and wrap this up pretty quick. There's two things. One is, how did the company finance in order to get their underlying capital? And if it was convertible debt that got them all of that crypto, then watch out, that's a problem. Because when Bitcoin drops, no matter what token you're holding, the media is waiting to say, see, I told you it was going to zero. In our world, the crypto world, that had an effect, but not that great. In the public markets, a lot of those shareholders are going to hear that and run for the hills. So it's a cascading effect that the world hasn't really seen yet. And I hope none of that happens. And maybe there's insulations built in. And some of the companies, you mentioned Jonathan Bates and Bitmine, to my knowledge, unless I'm wrong now, they did it on equity. They're not sitting out there with billions of dollars worth of debt that I know of. I want to leave some room for that. But that is a smart strategy. While they get a little bit of flack for doing that, that is the kind of thing that can save a company. So how it's done is just as important.
So that would be the ATM strategy. So Keith, do you want to talk about the best ways to finance these to sort of insulate one's company from the inevitable downturns that happen in the market?
Yeah, well, I'm a big believer in equity and avoiding leverage because, like Enzo said, the markets do cycle. And, I've told more than one client after we took them public, maybe you just want to sit on your cash and just wait. But unfortunately, everybody has this mindset that, they have to grow their business. But there are times when the market doesn't pay for you to grow your business. As a matter of fact, they punish you to grow your business, right? And I've been in small caps my entire career, and, we've kind of just gone through one of those cycles. It doesn't matter what your story is, what you're telling people, the market was punishing you because you were burning cash, even though you were burning it under the assumption that you were growing your business. So, don't over leverage, avoid the toxic guys for sure. And these crazy instruments that are a common share and two, what we call exploding warrants, that basically wipe out the equity, that you've built up. So, those are just simple things to try and avoid. And like I said, I'll give anybody any ideas that I have because I've learned a lot, most importantly, what not to do.
Some great guidance from the pros here. And Josh, you get the last word before Joyce comes with a big hook.
Oh, okay, I'll be quick. So I think the word DAT is gonna disappear in kind of the way the word NFT kind of disappears. there's been kind of a new shiny tool that was discovered. And a lot of people, mostly service providers, ran to it and said, okay, let's do this. And not surprisingly, a lot of them don't work, but a bunch of them do also. So I think on a go-forward basis, you're going to see companies that work, that use a digital asset treasury strategy or have digital assets as part of their operating strategy. We're just not going to call them DATs.
Companies.
We're going to call them lawlers.
Okay, thank you, panel, and I guess we're more or less on time. Thank you.
Tokenize, let's innovate, bringing assets to the digital state. From finance to games, we're redefining, connecting the dots. The future is shining.